Question 1. An investment advisor representative, IAR, is recommending an investment strategy to a new client. Under the Uniform Securities Act, what is the IAR's primary standard of care for this client? A. Suitability, ensuring the recommendation aligns with the client's investment profile. B. Fiduciary duty, requiring the IAR to act in the client's best interest. C. Best execution, obtaining the most favorable terms for the client's trades. D. Disclosure, ensuring all material facts are presented to the client. Answer, B. Fiduciary duty, requiring the IAR to act in the client's best interest. Investment advisor representatives, IARs, and investment advisors, IAs, operate under a fiduciary standard, which is a higher standard than the suitability standard applicable to broker-dealers and their agents. A fiduciary is legally obligated to act solely in the best interest of their client, placing the client's interests above their own. This encompasses a duty of loyalty and care, going beyond merely recommending suitable investments to actively avoiding conflicts of interest and disclosing any that exist. Understanding this fundamental distinction is crucial for Series 65 candidates. Question 2. An investment advisor manages accounts solely for residents of 2 states, holding $95 million in assets under management, AUM. Which regulatory authority typically governs this investment advisor? A. The SEC, due to exceeding the $25 million AUM threshold. B. State administrators in both states, as AUM is below $100 million. C. FINRA, regardless of AUM or location. D. Both the SEC and state administrators, requiring dual registration. Answer, B. State administrators in both states, as AUM is below $100 million. Generally, investment advisors with $100 million or more in AUM must register with the SEC, federal registration, while those with less than $100 million in AUM register with state administrators. However, an advisor managing between $25 million and $100 million may choose to register with the SEC if they would otherwise be required to register in 15 or more states. In this case, with $95 million AUM and operating in only 2 states, the IA falls under state registration requirements, specifically with the administrators in those 2 states. This threshold is a key determinant of regulatory jurisdiction for investment advisors. Question 3. A financial analyst is evaluating 2 mutually exclusive projects. Project A has an initial cost of $100,000 and is expected to generate cash flows of $30,000 per year for 5 years. Project B has an initial cost of $120,000 and is expected to generate cash flows of $35,000 per year for 5 years. Assuming a discount rate of 10%, which project should the analyst recommend based on net present value, NPV, criteria? A. Project A, because it has a lower initial cost. B. Project B, because it generates higher annual cash flows. C. The project with the higher positive NPV, requiring calculation. D. Neither project, as the internal rate of return, IRR, is the preferred metric for mutually exclusive projects. Answer, C. The project with the higher positive NPV, requiring calculation. When evaluating mutually exclusive projects, the net present value, NPV, rule dictates choosing the project with the highest positive NPV, as this indicates which project will add the most value to the firm. While initial cost and annual cash flows are components, they don't solely determine the best choice without considering the time value of money via discounting. The IRR can be misleading for mutually exclusive projects due to issues like multiple IRRs or differing project sizes and timing of cash flows, making NPV a more reliable criterion. Therefore, a proper calculation of NPV for each project is necessary to make an informed recommendation. Question 4. An investment advisor representative, IAR, is analyzing a stock using the capital asset pricing model, CAPM. The stock has a beta of 1:5. If the risk-free rate is 3% and the market risk premium is 6%, what is the stock's expected return? A. 9%. B. 12%. C. 5%. D. 15%. Answer, B. 12%. The capital asset pricing model, CAPM, calculates the expected return of an asset using the formula. Expected return equals risk-free rate plus beta asterisk, market return, risk-free rate. The term, market return, risk-free rate, is known as the market risk premium. Therefore, plugging in the given values. Expected return equals 3% plus 1.5 asterisk 6% equals 3% plus 9% equals 12%. CAPM is a fundamental tool for determining the theoretically appropriate required rate of return of an asset, considering its systematic risk, beta, relative to the market. Question 5. A high-net-worth client residing in New York is considering investing in a municipal bond issued by the City of Albany, New York. What is the typical tax treatment of the interest income from this bond for the client? A. Fully taxable at the federal, state, and local levels. B. Exempt from federal income tax, but taxable at the state and local levels. C. Exempt from federal, New York State, and New York local income taxes. D. Exempt from state and local income taxes, but taxable at the federal level. Answer, C. Exempt from federal, New York State, and New York local income taxes. Interest income from municipal bonds is generally exempt from federal income tax. Additionally, if an investor purchases a municipal bond issued by a municipality within their own state of residence, the interest income is typically exempt from state and local income taxes as well. This is known as the double tax exempt or triple tax exempt benefit. For a New York resident investing in a bond issued by the City of Albany, within New York, the interest income would be exempt from federal, New York State, and New York local income taxes, making them particularly attractive to high-income earners in their resident state. Question 6. Under the Uniform Securities Act, USA, which of the following would generally not be considered a security? A. An investment contract for a condominium in a resort property with a mandatory rental pool. B. A fixed annuity contract. C. A variable annuity contract. D. Shares in a publicly traded limited partnership. Answer, B. A fixed annuity contract. The Uniform Securities Act, USA, defines a security broadly, often using the Howey test, investment of money, in a common enterprise, with the expectation of profits, solely from the efforts of others. While variable annuities are considered securities because their value fluctuates based on the performance of underlying investment options, fixed annuities are typically not considered securities. Fixed annuities promise a guaranteed rate of return and do not involve investment risk borne by the purchaser, they are insurance products. Investment contracts, like the condo example, and shares in partnerships that meet the Howey test are generally considered securities. Question 7. A client is considering investing in an investment company that trades on an exchange throughout the day and can trade at a premium or discount to its net asset value, NAV. This description best fits which type of investment vehicle? A. An open-end management company. B. A unit investment trust, UIT. C. A closed-end management company. D. An exchange-traded fund, ETF. Answer, C. A closed-end management company. Closed-end management companies issue a fixed number of shares that trade on stock exchanges, similar to individual stocks. Because their shares trade in the secondary market, their market price is determined by supply and demand, and can therefore trade at a premium, above, or discount, below, their net asset value, NAV. Open-end funds, mutual funds, are continuously issued and redeemed by the fund at their NAV, while ETFs, though exchange-traded, generally maintain a market price close to NAV due to arbitrage mechanisms. UITs are unmanaged, fixed portfolios that also redeem at NAV. Question 8. Under the Uniform Securities Act, if the state administrator believes a person has engaged in or is about to engage in an act constituting a violation of the act, what action may the administrator take? A. Impose a civil penalty of up to $10,000 without a hearing. B. Issue a cease and desist order without prior notice or hearing. C. Initiate an investigation and require the person to produce documents or appear for examination under oath. D. Immediately revoke the person's registration without cause. Answer: C. Initiate an investigation and require the person to produce documents or appear for examination under oath. The state administrator has broad powers to investigate potential violations of the Uniform Securities Act. If there's reason to believe a violation has occurred or is imminent, the administrator can subpoena witnesses, compel the production of documents, and require individuals to testify under oath. While cease and desist orders can be issued, they generally require notice and an opportunity for a hearing. Penalties and revocations typically follow an investigation and a finding of violation, often after a hearing, rather than being immediate first steps without due process. Question 9. According to ERISA, Employee Retirement Income Security Act, Section 404, c. A plan fiduciary may be relieved of liability for investment losses if which of the following conditions is met. A. The plan offers at least 3 diversified investment options with materially different risk and return characteristics. B. The participant provides written acknowledgement that they understand the risks of their chosen investments. C. The fiduciary personally approves all participant investment elections. D. The plan assets are invested solely in conservative, guaranteed return products. Answer: A. The plan offers at least 3 diversified investment options with materially different risk and return characteristics. ERISA Section 404, c. provides a safe harbor for fiduciaries of participant-directed defined contribution plans. To qualify for this protection, the plan must offer participants a broad range of investment options, typically meaning at least 3 diversified core investment alternatives, each with materially different risk and return characteristics. This allows participants sufficient choice to diversify their accounts and manage their own risk. The purpose is to shift some investment responsibility to the participant, provided they have adequate information and choices, not to relieve the fiduciary of all responsibility without meeting specific structural requirements. Question 10. A client is comparing a qualified retirement plan to a non-qualified deferred compensation plan. Which statement accurately describes a key difference between them? A. Contributions to both types of plans are always tax-deductible for the employee. B. Qualified plans are subject to ERISA requirements, providing participant protections, while non-qualified plans are generally not. C. Distributions from qualified plans are always tax-free, whereas distributions from non-qualified plans are always taxable. D. Non-qualified plans generally offer immediate tax deductions for employers when contributions are made. Answer: B. Qualified plans are subject to ERISA requirements, providing participant protections, while non-qualified plans are generally not. Qualified retirement plans, e.g., 401(k) pension plans, must comply with the Employee Retirement Income Security Act, ERISA, which provides strict rules regarding participation, funding, vesting, and fiduciary responsibility to protect plan participants. Non-qualified deferred compensation plans, conversely, are typically exempt from most ERISA provisions, offering greater flexibility in design and eligibility but less protection for the employee. While both types of plans often aim for tax-deferred growth of earnings for the employee, the ERISA distinction is a fundamental and consistent difference. Question 11. An investment advisor representative is comparing two portfolios. Portfolio X has an average return of 12%, a standard deviation of 15%, and the risk-free rate is 3%. Portfolio Y has an average return of 10%, a standard deviation of 10%, and the risk-free rate is 3%. Which portfolio has a better risk-adjusted return according to the Sharpe ratio? A. Portfolio X, because it has a higher average return. B. Portfolio Y, because it has a lower standard deviation. C. Portfolio X, Sharpe ratio equals 0, 60. D. Portfolio Y, Sharpe ratio equals 0, 70. Answer, D. Portfolio Y, Sharpe ratio equals 0, 70. The Sharpe ratio measures risk-adjusted return by calculating the excess return per unit of total risk, standard deviation. The formula is, portfolio return, risk-free rate, / standard deviation. For portfolio X, 12%, 3%, / 15% equals 9% / 15% equals 0, 60. For portfolio Y, 10%, 3%, / 10% equals 7% / 10% equals 0, 70. Since a higher Sharpe ratio indicates a better risk-adjusted performance, portfolio Y has a better risk-adjusted return. This metric is valuable for comparing portfolios that may have different levels of total risk. Question 12. A client wants to invest $80,000 in a mutual fund that offers breakpoints at $100,000 and $250,000. To qualify for the $100,000 breakpoint and reduce sales charges on future purchases, which of the following is the most appropriate action for the client? A. Sign a letter of intent, LOI, to invest an additional $20,000 over the next 13 months. B. Invest the full $80,000 and wait for the fund's value to appreciate to $100,000. C. Purchase shares from another mutual fund in the same fund family to aggregate the investment. D. Invest $100,000 immediately, as an LOI only applies to initial investments. Answer, A. Sign a letter of intent, LOI, to invest an additional $20,000 over the next 13 months. A letter of intent, LOI, allows an investor to qualify for a breakpoint by agreeing to invest a certain amount over a future period, typically 13 months, often backdated up to 90 days. The investor receives the lower sales charge immediately and is obligated to complete the investment to reach the specified breakpoint. Appreciated value does not count toward breakpoints, and while purchases within the same fund family can sometimes be aggregated, an LOI is the direct mechanism to achieve a breakpoint with a planned future investment. This strategy helps investors reduce sales loads without having all the capital upfront. Question 13. An investor holds a bond with a 6% coupon rate, a par value of $1,000, and a current market price of $950. The bond has 5 years remaining until maturity. Which statement accurately compares the bond's current yield to its yield to maturity, YTM? A. The current yield will be lower than the YTM because the bond is trading at a discount. B. The current yield will be higher than the YTM because the bond is trading at a discount. C. The current yield will be equal to the YTM, as both reflect the bond's income relative to its price. D. The current yield is 60/950. And the YTM is 60/950. Plus 1000-950/5/950, so YTM is higher. Answer, D. The current yield is 60/950. And the YTM is 60/950. Plus 1000-950/5/950, so YTM is higher. A bond trading at a discount, market price below par, will have a current yield that is higher than its coupon rate. Its yield to maturity, YTM, will be even higher than the current yield. This is because YTM takes into account not only the annual interest payments but also the capital gain the investor will realize when the bond matures at par. The difference between par, $1,000, and the discount price, $9.50, is spread over the remaining years, adding to the overall return, thus making YTM higher than the current yield. Question 14. An investment advisor representative, IAR, manages a trust account for a client. Under the Prudent Investor Rule, what is the primary consideration for the IAR when making investment decisions for this trust? A. Maximizing short-term capital gains to generate immediate income for the beneficiaries. B. Avoiding all investments with any level of risk to preserve capital. C. Evaluating the investment in the context of the entire portfolio and the trust's overall investment objectives. D. Investing only in securities issued by large-cap, financially stable corporations. Answer, C. Evaluating the investment in the context of the entire portfolio and the trust's overall investment objectives. The Prudent Investor Rule, adopted by most states, modernizes the traditional, prudent man rule by emphasizing a portfolio approach to investment decisions. It requires fiduciaries to consider investments within the context of the entire portfolio, taking into account the trust's overall risk tolerance, return objectives, liquidity needs, and diversification. It explicitly permits investing in riskier assets if they contribute to the overall portfolio's risk-return characteristics, moving away from a single investment focus. The rule focuses on the process and overall portfolio strategy rather than on individual asset performance or strict risk aversion. Question 15. Which type of bond is most susceptible to reinvestment risk? A. A 30-year zero-coupon bond. B. A 10-year Treasury bond with a 5% coupon paid semi-annually. C. A 2-year Treasury bill. D. A TIPS, Treasury inflation-protected security. Answer, B. A 10-year Treasury bond with a 5% coupon paid semi-annually. Reinvestment risk is the risk that income from a bond's coupon payments, when reinvested, will earn a lower rate of return than the bond's original yield. Bonds with frequent and substantial coupon payments, like a long-term Treasury bond with semi-annual coupons, are most exposed to this risk. Zero-coupon bonds have no coupon payments to reinvest, thus no reinvestment risk. Short-term instruments like Treasury bills have very little reinvestment risk due to their brief maturity. TIPS principal adjusts with inflation, but the coupon itself is still subject to reinvestment risk in the same way as other coupon bonds. Question 16. An investment advisor, IA, is required to deliver a Form ADV Part 2A, the brochure, to a prospective client. What is the primary purpose of this document? A. To provide the client with a detailed list of all securities held in the IA's proprietary accounts. B. To disclose the IA's business practices, fees, conflicts of interest, and disciplinary information. C. To act as the official registration application filed with the SEC or state administrator. D. To present a customized investment policy statement for the prospective client. Answer, B. To disclose the IA's business practices, fees, conflicts of interest, and disciplinary information. Form ADV Part 2A, also known as the brochure, is the main disclosure document that an investment advisor must provide to clients. Its primary purpose is to inform clients about the IA's services, fees, methods of analysis, investment strategies, potential conflicts of interest, and any significant disciplinary history. This detailed disclosure is crucial for clients to make informed decisions about engaging an investment advisor. It is distinct from the registration application, Form ADV Part 1, and a client's personalized investment policy statement. Question 17. A client wants to mitigate the risk of market timing when investing in a volatile equity fund. Which strategy would best address this concern? A. Lump sum investing during market downturns. B. Asset allocation with a strict rebalancing schedule. C. Dollar cost averaging. D. Investing solely in a passively managed index fund. Answer: C. Dollar cost averaging. Dollar cost averaging is a strategy where an investor invests a fixed amount of money at regular intervals, regardless of the share price. This approach helps to reduce the average cost per share over time because more shares are purchased when prices are low, and fewer shares when prices are high. By consistently investing, it removes the need to time the market and reduces the risk associated with making a single large investment at an inopportune time. Question 18. An investor holds a callable bond. If interest rates decline significantly, what is the most likely action the issuer will take, and what is the primary risk to the investor? A. The issuer will likely redeem the bond, exposing the investor to reinvestment risk. B. The issuer will likely increase the bond's coupon rate, benefiting the investor. C. The issuer will likely extend the bond's maturity date, stabilizing the investor's income. D. The issuer will likely default on the bond, exposing the investor to credit risk. Answer: A. The issuer will likely redeem the bond, exposing the investor to reinvestment risk. Callable bonds give the issuer the right to redeem the bond prior to its stated maturity date. Issuers typically exercise this call feature when interest rates have fallen, allowing them to refinance their debt at a lower cost. For the investor, the primary risk associated with a callable bond is reinvestment risk, meaning they will receive their principal back earlier than expected and will likely have to reinvest it at a lower prevailing interest rate, potentially reducing their future income. Question 19. An investment advisor representative, IR, receives non-public, material information about a pending merger from an executive of one of the companies involved. The IAR then advises several clients to purchase shares of the target company before the merger is publicly announced. This action constitutes which type of violation? A. Churning. B. Front-running. C. Insider trading. D. Market manipulation. Answer: C. Insider trading. Insider trading involves trading securities based on material, non-public information obtained in breach of a fiduciary duty or other relationship of trust and confidence. In this scenario, the IAR is using confidential merger information to recommend trades, directly violating insider trading rules. Churning involves excessive trading for commissions, front-running is trading ahead of client orders, and market manipulation involves intentionally creating artificial prices. Using inside information for personal gain or to benefit clients is a clear case of insider trading. Question 20. A client is considering purchasing a variable annuity. Which fee or charge is unique to variable annuities and compensates the insurance company for the risk of the annuitant living longer than expected? A. Sales charges, loads. B. Administrative fees. C. Mortality and expense, M&E, charges. D. Investment management fees. Answer: C. Mortality and expense, M&E, charges. Mortality and expense, M&E, charges are a unique feature of variable annuities. These fees compensate the insurance company for the mortality risk, the risk that annuitants live longer than actuarially predicted, requiring more payout from the insurer, and for covering administrative expenses, marketing, and a guarantee of annuity payments. While variable annuities also have sales charges, administrative fees, and investment management fees, for the subaccounts, the M&E charge is specifically tied to the insurance aspect and the mortality guarantee inherent in the annuity contract. Question 21. A 60-year-old client, who opened a Roth IRA 5 years ago, plans to take a distribution from her account. Assuming all contributions were made with after-tax dollars, what is the tax treatment of qualified distributions from her Roth IRA? A. Both contributions and earnings are fully taxable as ordinary income. B. Contributions are tax-free, but earnings are taxable as ordinary income. C. Both contributions and earnings are entirely tax-free. D. Contributions are taxable, but earnings are tax-free. Answer: C. Both contributions and earnings are entirely tax-free. Qualified distributions from a Roth IRA are entirely tax-free and penalty-free. For a distribution to be qualified, two conditions must be met: the account must have been open for at least 5 years, the 5-year aging rule, and the account owner must be at least 59.5 years old, disabled, or using the funds for a first-time home purchase. Since the client is 60 and the account has been open for 5 years, her distribution would be qualified, meaning both her after-tax contributions and accumulated earnings will be received free of any federal income tax. Question 22. According to the semi-strong form of the efficient market hypothesis, EMH, which of the following types of information is already reflected in a stock's current price? A. Only historical price and volume data. B. All publicly available information, including financial statements and news. C. All public and private, insider, information. D. Only the fundamental value based on intrinsic analysis. Answer: B. All publicly available information, including financial statements and news. The semi-strong form of the efficient market hypothesis, EMH, posits that all publicly available information is already reflected in a stock's current market price. This includes not only historical price data, which is covered by the weak form, but also all fundamental data such as financial statements, earnings announcements, news articles, and economic forecasts. Therefore, neither fundamental analysis nor technical analysis can consistently generate abnormal returns based on publicly available information. Only private or insider information would potentially allow for excess returns under the semi-strong form. Question 23. Which of the following events would generally lead to a statutory disqualification for an individual seeking to register as an investment advisor representative, IR, under the Uniform Securities Act? A. A misdemeanor conviction for reckless driving 2 years ago. B. A civil lawsuit filed against the individual alleging poor investment advice. C. A felony conviction for securities fraud within the last 10 years. D. A personal bankruptcy filing more than 10 years ago. Answer: C. A felony conviction for securities fraud within the last 10 years. Under the Uniform Securities Act, statutory disqualification typically arises from felony convictions, particularly those related to securities, money, or investments, within the past 10 years. Misdemeanors not involving financial crimes generally do not lead to automatic disqualification. Civil lawsuits or old bankruptcies might require disclosure but do not automatically disqualify an applicant. A felony conviction for securities fraud within the 10-year look-back period is a clear cause for statutory disqualification, prohibiting registration unless a waiver is granted by the administrator. Question 24. A client is considering an investment in a limited partnership, LP. Which statement accurately describes a key characteristic or risk associated with LPs? A. Limited partners have unlimited liability for partnership debts. B. Limited partnerships offer a high degree of liquidity, as interests are easily traded on exchanges. C. General partners typically manage the business and have unlimited liability. D. The income generated by an LP is typically tax-exempt at the federal level. Answer: C. General partners typically manage the business and have unlimited liability. In a limited partnership, there are two types of partners: general partners, GPs. and limited partners, LPs. General partners are responsible for managing the business and, in return, bear unlimited personal liability for the partnership's debts and obligations. Limited partners are passive investors whose liability is limited to the amount of their investment. LPs are generally illiquid investments, and while they offer pass-through taxation, no corporate tax, the income is typically taxable to the partners, not tax-exempt. Question 25. A portfolio manager holds a highly diversified portfolio of U.S. large cap equities. Which type of risk is the manager primarily exposed to, which cannot be eliminated through diversification? A. Business risk. B. Specific risk. C. Liquidity risk. D. Market risk. Answer, D. Market risk. Market risk, also known as systematic risk, is the risk that the overall market will decline, impacting all investments within that market. This type of risk is inherent to the broad market and cannot be eliminated through diversification. Business risk and specific risk, also called unsystematic risk, are risks specific to an individual company or industry and can be substantially reduced or eliminated through proper diversification. A highly diversified portfolio primarily faces systematic risk, as firm-specific risks have been diversified away. Question 26. An investment advisor, IA, receives research services from a broker-dealer in exchange for directing client commissions to that broker-dealer. This arrangement is known as a soft dollar arrangement. Which of the following is a permissible use of soft dollars under Section 28(e) of the Securities Exchange Act of 1934? A. Payments for office rent and administrative salaries of the IA. B. Computer hardware and software used for client reporting and administrative tasks. C. Research reports and financial analysis tools directly assisting the IA in making investment decisions. D. Entertainment expenses for the IA's clients. Answer, C. Research reports and financial analysis tools directly assisting the IA in making investment decisions. Section 28(e) of the Securities Exchange Act of 1934 provides a safe harbor for soft dollar arrangements, allowing investment advisors to use client commissions to obtain brokerage and research services. To be permissible, the research must provide a direct benefit to the client, assisting the IA in making investment decisions. Services like research reports, analytical software, and market data fit this criterion. Non-research items such as office rent, administrative expenses, or client entertainment are considered hard dollars and cannot be paid for with client commissions under a soft dollar arrangement. Question 27. A client is considering investing in a preferred stock that pays a fixed annual dividend of $5.00 per share. If the required rate of return for similar preferred stocks is 8%, what is the intrinsic value of this preferred stock? A. $40.00. B. $62.50. C. $80.00. D. $100.00. Answer, B. $62.50. Preferred stock valuation can be treated as a perpetuity, as preferred stocks typically pay a fixed dividend indefinitely. The formula for valuing a perpetuity is dividend/required rate of return. In this case, the intrinsic value is $5.00, annual dividend, /0.08, required rate of return, equals $62.50. This calculation helps investors determine a fair price for preferred stock based on its consistent income stream and the prevailing market return expectations for similar investments. Question 28. Which of the following bonds would generally have the highest duration? A. A 5-year, 7% coupon bond. B. A 10-year, 5% coupon bond. C. A 10-year zero coupon bond. D. A 15-year, 8% coupon bond? Answer, C. A 10-year zero coupon bond. Duration is a measure of a bond's price sensitivity to changes in interest rates, and it also represents the weighted average time until a bond's cash flows are received. Bonds with longer maturities and lower coupon rates generally have higher durations. Zero coupon bonds, which pay all their return at maturity, have a duration equal to their maturity, making them the most sensitive to interest rate changes among comparable maturity bonds. Therefore, a 10-year zero coupon bond would have a higher duration than any of the coupon-paying bonds, even those with longer maturities but significant intermediate cash flows. Question 29. A client has realized significant capital gains from stock sales this year. To offset these gains, the investment advisor representative, IR, recommends selling some depreciated securities from the client's portfolio. What is this strategy called, and what is a key rule to consider? A. Wash sale, and the client must repurchase the same security within 30 days. B. Capital gains deferral, and the client must invest in an opportunity zone fund. C. Tax loss harvesting, and the client cannot repurchase a substantially identical security within 30 days before or after the sale. D. Portfolio rebalancing, and there are no specific tax rules to consider. Answer, C. Tax loss harvesting, and the client cannot repurchase a substantially identical security within 30 days before or after the sale. This strategy is known as tax loss harvesting, where investors sell securities at a loss to offset capital gains and potentially a limited amount of ordinary income, $3,000 per year. A critical rule to remember for tax loss harvesting is the wash sale rule. This rule states that if an investor sells a security at a loss and repurchases a substantially identical security within 30 days before or after the sale, the loss is disallowed for tax purposes. This prevents investors from claiming a loss while effectively maintaining their investment position. Question 30. Which of the following economic indicators is considered a lagging indicator? A. Building permits. B. Stock market prices. C. Unemployment rate. D. Manufacturers' new orders for capital goods. Answer, C. Unemployment rate. Lagging indicators are economic data points that tend to change after the economy has already begun to follow a particular pattern or trend. The unemployment rate is a classic example of a lagging indicator. It typically begins to decline after an economic recovery is already underway, and rises after a recession has started. In contrast, building permits, stock market prices, and manufacturers' new orders are generally considered leading indicators, as they tend to predict future economic activity. Question 31. A small startup company seeks to raise capital by selling securities directly to a limited number of sophisticated investors without requiring full SEC registration. This offering would most likely be conducted under which exemption? A. Regulation A. B. Rule 144. C. Regulation D. D. Rule 504. Answer, C. Regulation D. Regulation D provides exemptions from SEC registration for private offerings of securities, often referred to as private placements. These exemptions allow companies to raise capital from accredited investors and a limited number of non-accredited investors, provided certain conditions regarding disclosure, advertising, and investor sophistication are met. Rule 504 is one of the specific rules under Regulation D, but Regulation D itself is the broader framework. Regulation A allows for smaller public offerings with simplified registration, and Rule 144 deals with the resale of restricted and controlled securities. Question 32. When developing an investment policy statement, IPS, for a client, which of the following is considered the most crucial component to establish before selecting specific investments? A. The asset allocation strategy. B. The historical performance of recommended investments. C. The client's risk tolerance and investment objectives. D. A list of specific securities to be purchased. Answer: C. The client's risk tolerance and investment objectives. The client's risk tolerance and investment objectives are the foundational elements of any effective investment policy statement, IPS. Before an appropriate asset allocation strategy can be determined or specific investments selected, it is paramount to understand what the client aims to achieve and how much risk they are willing and able to take. All subsequent decisions, from asset allocation to security selection, must align with these core client characteristics to ensure suitability and maximize the likelihood of achieving their financial goals. Question 33. A client is evaluating an exchange-traded fund, ETF, versus an open-end mutual fund. Which characteristic is typically associated with ETFs but not with traditional open-end mutual funds? A. Can be bought and sold throughout the trading day at market prices. B. Provides professional management and diversification. C. Calculates net asset value, NAV, once per day. D. Purchases and redemptions are directly with the fund company. Answer: A. Can be bought and sold throughout the trading day at market prices. Exchange-traded funds, ETFs, trade on stock exchanges throughout the day, allowing investors to buy and sell shares at prevailing market prices, much like individual stocks. In contrast, traditional open-end mutual funds are priced only once per day, at the close of trading, based on their net asset value, NAV. Both ETFs and mutual funds offer professional management and diversification. While mutual funds involve direct purchases/redemptions with the fund company, ETFs are typically bought and sold in the secondary market. Question 34. For a high-income client, interest income from which of the following municipal bonds might be subject to the alternative minimum tax, AMT? A. General obligation bonds issued by a state government. B. Public purpose industrial development bonds. C. Private activity municipal bonds. D. Revenue bonds funding a municipal toll road. Answer: C. Private activity municipal bonds. Generally, interest income from municipal bonds is exempt from federal income tax. However, interest from private activity municipal bonds, which are issued to finance projects that primarily benefit private corporations or individuals rather than the general public, can be a preference item for the alternative minimum tax, AMT. This means that for high-income taxpayers subject to AMT, this interest income may become taxable. Public purpose bonds, like general obligation bonds or revenue bonds for essential public services, are typically exempt from AMT. Question 35. An investment advisor representative, IR, learns that a client is experiencing severe financial distress and is contemplating bankruptcy. A mutual friend asks the IAR about the client's financial situation. What is the IAR's ethical obligation regarding this information? A. Disclose the information to the mutual friend to seek advice on how to help the client. B. Disclose the information to the client's family members, as they may be able to assist. C. Maintain strict confidentiality, as client information is privileged. D. Inform the firm's compliance department, which may then disclose to the friend. Answer: C. Maintain strict confidentiality, as client information is privileged. Investment advisor representatives, IARs, have a fundamental ethical and legal duty to maintain the confidentiality of client information. This fiduciary duty prohibits sharing private client details with anyone, including family members or mutual friends, without the client's explicit consent or a legal requirement, e.g., a court order. Breaching confidentiality undermines the trust essential to the client-advisor relationship and can lead to severe disciplinary actions. The IAR's obligation is to protect the client's privacy, regardless of the perceived intentions of the inquiring party.